Hey everyone, thank you so much for spending some minutes with me. Today I want to talk about pre-seed funding and seed funding and stuff like that. I'm going to do it using this information you see on the screen. I was doing some research for me and I was able to find a diagram that explains this quite well. Is this diagram here? Actually, there is more information I'm going to show you like in a second in the next few pages, but I wanted to start with this one. And then if you stay until the end, you will see also where this information is coming from, so you can use it for your purposes going forward when this gets updated, etc. So let's start with pre-seed. And for this, I'm going to use an example. Let's suppose that you have three other co-founders, technical co-founders, for example. So it's a team of 4 people, and you want to start a company. And so you need some money in order to do that. Now, the information here on the screen, this is from the US and it's based on the fourth quarter of 2024. But actually, you can use it just as an indication to understand what this means and apply it for your cases going forward. So when you do a pre-seed round, basically your milestone is you just need to have like a clear vision and a very good idea of what you want to build. And then the goal is you want to raise some funds from potential investors who basically will invest the money so that you can build an MVP and get some feedback from early users. Now, as you can see on the screen, for example, for those transactions that were closed in the fourth quarter of 2024, about 50% of them were able to raise $1 million from pre-seed. And that's including a dilution of 10%. So that means that at this point, their companies were valued at $11 million post money, which means $10 million before this round, plus 1 million in cash raised for this pre-seed. That's a total of $11 million. And so you can see here the 25th percentile, it's they raised a bit more than $500,000. And the 75th percentile, they raised about $1.4 million. So this gives you an indication when you try to raise some money for pre-seed, you should be able to raise between $500,000 and $2 million with this type of transaction. And so what happens is when you start your project, those 4 co-founders that we were discussing have 100% of ownership. And so after raising this round, there is a 10% dilution, which means that the founders, after raising this, will have 90% of the company, and the future equity holders will have 10%. What does it mean that these are future equity holders? As you can see here on the left-hand side, it says safe rounds. And a safe round is basically a bit different to a traditional price round. A SAFE is basically a simple agreement for future equity. So this is a contract between the startup and the investor, where the investor provides some capital in exchange for the right to receive future equity when a qualifying event, usually a priced equity round, happens. So at this point, it's very difficult when you are starting the company to get the proper valuation for the company. So it's very difficult for you and the investors to decide on the potential value of the company going forward, etc. And so what happens is companies use these simple agreements in order to get some initial funding. Why? Because you don't need to set this valuation immediately. All this simplifies the fundraising process. If you are discussing some other types of funding, like convertible notes or some loans with interest, all those things are a bit just more complex. I remember about 20, 25 years ago for my first startup, I was discussing with a bank and they wanted to have my personal warranty behind that interest rate, etc. So I never did. So obviously the SAFE agreement simplifies all that process. And if you do a pre-seed round with SAFE, you will not be diluted immediately because those agreements will convert when a price round happens in the future, whenever there is a priced seed round or when there is a Series A type of event. So in this next page, I want to talk now about the safe seed, right? So we've discussed the pre-seed. Now we would be on the second here. And for the 50th percentile, you can see that companies raised about $3 million for an 18% dilution with a post-money valuation of $18 million. If you wanted to be more on the safe side, you could argue that on the 25th percentile, the companies raised $2.4 million. And there were also some other companies on the 75th percentile, for example, that raised about $4 million for now 26% dilution. So let's do the numbers again. For those 4 co-founders that started the company, now before this round, they had 90%. So if we now apply the 18% dilution again, that means that they would now own 74% of the company. For those investors that invested in the pre-seed round with the SAFE agreement, they had 10% with now an 18% dilution. That means that now they own 8.2% of the company. And for the new investors who are basically investing in this seed on safe round, they get 18% of the company. So at this point, if we come up here, you can see that the milestone in order to be able to do a safe seed is that now you have an MVP that you have been putting together with the money you got from the pre-seed, right? With some users who are already using your MVP. And the goal with the money is to basically prove user demand, start getting users who pay for the product, and refine your go-to-market strategy. The next one is the price seed. At this point, you basically have user growth. Those users are paying and you are able to retain them. And your goal is to raise additional funds so you can do more scaling and you can prove some of the metrics before you go into a Series A discussion. This is the first financing round where actually the investors will get shares from the company instead of additional agreements or convertible notes and stuff like that. And you want to do this type of round because you want to get a strong valuation foundation before you get excessive dilution at Series A, because those investors without the price seed, they will not know how much the company is valued at. Here you can see that on the 15th percentile, companies were able to raise about $4 million for a 20% dilution. Bringing the total post-money valuation of those startups at $19 million. And on the lower end, on the 25th percentile, companies raised about $2 million for a 15% dilution. And on the 75th percentile, companies raised about $6 million for a 25% dilution. Now, let's think about those founders that started the company. Before this round, they had about 74%. So now we apply another 80% dilution. That means that after this round, they'll own 60% of the company. The initial pre-seed safe holders would now have equity into the company because all these safes will convert into equity at this point, and they would own 6.56% of the company. And the seed safe holders would own 18% minus the 20% discount. They would now own 14.4% of the company. And the investors investing at this price seed round, they would now own 20% of the company. So this is the full diagram. Information comes from carta.com. Feel free to go to the website in the future and update accordingly. But basically, this is a summary of the 1,500 rounds in the US in Q4 2024. So we've discussed the pre-seed, the seed, and the price seed, but obviously you have more information here for a Series A, B, and C. And if you continue that example I was giving you about the 4 co-founders, those co-founders, if they did all these rounds, they would still be able to control the ownership of the company together, and they would have been able to raise 12, 15, 18, about $20 million. So please feel free to send me any questions or comments that you have. I hope you like the value in this video. If so, please like and subscribe to my channel. Thank you so much and talk to you soon.